Friends, now we are going to learn about the dividend relevance theories. And in the dividend relevance theory, the conclusion will be that the dividend payout ratio or the policy that is employed by the company with respect to payment of dividend will definitely affect the value of the firm. Okay, so all these theories which we are going to see hereafter will be dividend relevance theories, which says that dividend policy have an impact or effect on the valuation of firm. Okay, so that is the conclusion. Now under this we are going to see the first model, and this model is what is known as Walters model. Okay, now like what we saw in the case of Modigliani-Miller approach, even in case of Walters model there are various assumptions. Okay, let's see what are the assumptions which are applicable or which needs to be satisfied before we go with the Walters model. Now assumption number 1, the first assumption will be, okay, now all the investment of the firm are to be financed through retained earnings only. That is assumption number 1. Okay, so all investments financed only by way of retained earnings. So if you want to go with a new project, then you have to have what? Retained earnings. Which means if you want to undertake any project, you need retained earnings, and hence your dividend payout will be reduced or will not be there at all accordingly. Okay, that is the first assumption. Now second assumption will be, here you have two things. One is rate of return on capital employed or capital invested. Okay, and that is denoted as R. Then you have cost of equity. Cost of equity, we don't have any debt, so we can say cost of equity or cost of capital. Both will be same as there is no debt. And that is KE. And both R and KE will be constant. So what is the difference between R and KE? This is very important to understand this particular model. R is the rate of return that the entity is able to generate by reinvesting its capital or by investing its capital. So you are making some profits and that profit is reinvested into the business. On that you will generate a return of R, that is return on capital. On the other hand, what is KE? KE is the cost of equity. Okay, and we have learned about cost of equity, its computations in capital structure chapter. Okay, so I am not going into that. So there is R and KE and both these values are constant. Okay, now the third one, perfect capital markets. We have seen the same assumption in case of approach also, perfect capital market. Then the next one, there are no transaction cost or flotation cost. No transaction or flotation cost. Again, one assumption which we had in approach also. Now next one, no taxes. No taxes means, so no difference between dividend paid and capital appreciation from tax perspective. Dividend paid and capital gain or capital appreciation. Okay, so if you are subject to a lower tax rate in case of dividend and a higher tax rate in capital appreciation, or otherwise a lower in capital appreciation and a higher in dividend paid, okay, this model is not valid there. Okay, so here the assumption is there is no taxes or there is no tax discrimination between your dividend income and capital appreciation. And the last assumption, firm has a perpetual life. Firm has a perpetual life. Perpetual life means you can expect this firm to have n number of years, and hence what you can do, we have that formula for valuing the firm. Okay, so we have learned about the valuation of the firms when it has got a perpetual life. Okay, simply capitalize the earnings, you will get the value of the firm. Okay, right. So these are the assumptions that needs to be satisfied before we implement or before we follow this Walters model. Now, once these assumptions are holding true, then as per Walters model, the market price of the firm, we have P0 is equal to D stands for dividend, plus E minus D. Okay, so just listen how I am writing this particular formula. D means the dividend paid. When the dividend paid at the end of first year. Okay, now what you are doing, E minus D. What is E? E is the earnings minus D. From earnings, if you less the dividend, you will get the retained earnings. So E minus D is the retained earnings. So this is the retained earnings. Now what you are doing with this retained earnings? This retained earnings you are reinvesting. When you reinvest, you are getting a return. What is the return that you are getting on this reinvestment? You are getting a return of E minus D is the capital you have invested into R. R is the rate of return on capital invested. So you are getting a return of E minus D into R. Now this is a return which you are going to get in future. Okay, now if you want to find out its value right now, and this return E minus D into R you will get for perpetual years, because whatever you are investing in the company, that capital is going to be with you for years. So every year you will get this E minus D into R. Okay, so we had this assumption called the firm has perpetual life. So if you want to find out what is the value of this retained earnings, what you need to do, you got the return. E minus D into R is the return. Okay, so this is the return. Now capitalize that. In order to capitalize, what do you have to do? Divide it by KE. Okay, so E minus D into R divided by KE will give you the capitalized value of the retained earnings. Now here is what you have to see. When you find out the return, you have multiplied it with R, but when you computed the present value or the capitalized value, the capitalization factor is cost of equity. We have discussed about this in our previous chapter also. Okay, now both dividend and this capitalized value are future values. Now you need to find out, to get the market price of the firm, you need to capitalize both these returns. Dividend will be paid every year, so you have to capitalize dividend also, and this E minus D into R by KE, that also you have to capitalize, because that is also a return you are getting every year. Okay, so what do you have to do? All divided by KE. Okay, so this is the formula, D plus E minus D into R by KE, all divided by KE. Now if you see the textbook, this formula is written little differently. So it is written as D plus R by KE into E minus D divided by KE. Slightly rearranging, bringing this R by KE at the beginning of the second formula. That's it. Okay, so this is the formula, and where? What is P? P is the market price of share. Okay, now D is the dividend per share. Either you can take it as dividend per share or total dividend, that's okay. Okay, now E is the earnings per share. Earnings per share. Now R is the rate of internal rate of return or return on investment. Okay, K is the cost of equity. Or I can say this is the capitalization factor. Okay, so this formula, what we are doing here is we are just capitalizing the return. Capitalizing the return to arrive at the perpetual value. Okay, that's it, nothing else. Okay, so this is the formula. Now if you see this formula, okay, this formula is mainly dependent on two factors. What is this? One is R and the other is K. So it is all based on this R and K. Your value of the firm will depend. Okay, now what is happening here? If, let's say, if I'm just trying to explain the logic here. Okay, suppose a company A Limited, yes, has a return on capital employed of, let's say, 20% and it has cost of equity of 10%. What is happening here? Suppose it has an EPS of, let's say, 10 rupee and DPS of, let's say, 4 rupee. Okay, so whatever EPS it is having, that is 10 rupee, that can be reinvested to get a return of how much? Return of R%, or you can get a return of 2 rupees by reinvesting 10 rupee. Now, if you reinvest that 10 rupee and generate 2 rupee out of it, okay, what is its value? Its value will be this 2 divided by cost of equity. What is cost of equity? Cost of equity is just 10%. So 2 divided by 10%. And when you say it is 2 divided by 10%, its value will be 20 rupees. So just see 20 rupees. So just see this. When R is greater than K, okay, the capitalized value of the return that you are getting by reinvesting your profits is more than the value of your capital. Your value of capital here, how much you have reinvested? You have reinvested only 10 rupee. So it is as good as you are paying dividend to the shareholders and asking them, see, we are able to reinvest at a higher rate of 20%, where your cost is only 10%. Okay, you are calling your equity shareholders and telling them, see, we have made a profit of 10 rupee. Now we have got two options. Either give this entire 10 rupee as dividend to you, and once you get this 10 rupee as dividend with you, what you can do? You can invest it and you can get 10% return, or you can save your 10% cost, because your cost of equity is only 10%. Okay, but if you ask or permit us to reinvest this entire amount, what will happen? We can reinvest it by generating a return of 20%. And if you do that, the capitalized value of that 10 rupee which we are reinvesting now will be more than 10 rupee, or it will be 20 rupee in this case. So by reinvesting your eligible dividend to the company, okay, you are able to grow your investment. That is what you will tell your equity shareholders as your R is greater than K. So as per this model, if R is greater than K, it is always wise, or it is always justified to retain the profits rather than paying out the dividend to the shareholders. Okay, so that is what this theory says. Now if you see the conclusions, you can write the dividend policy of the firm depends on two factors, that is R, return on investment by firm, and KE, that is cost of equity, or it is same as cost of retained earnings. Okay, now you have the decision making matrix here. Okay, so what is the condition? Condition, then type of company, dividend decision. Okay, dividend decision. So the condition, the first condition is R is equal to KE. Okay, you are able to reinvest your dividend at the same rate of return what the equity shareholders will get, or what the equity shareholders expect from you. So R is equal to KE. So which means it is a constant company. Okay, the company is neither growing nor declining. So what you have to do in this case, the dividend, whatever be, whether you whatever profits you are generating, whether you pay 100% of it, or 20% of it, or 50% of it, or 80% of it, or whatever be the percentage, or even if you don't pay any dividend, it is not going to affect your value, because R is equal to KE. And the investors are also indifferent, because if you keep it in a company, you will get the same return. If you give us and we reinvest or we repay our debt obligations, the same return what we are getting. So the shareholders are not bothered about whether they are paying or whether they are retaining. Okay, so here is dividend decision. Every dividend payout ratio is indifferent. Okay, investors are neither benefited nor lose by retained earnings. They are not getting any extra benefit. That is when R is greater than KE. Sorry, R is equal to KE. Now next, R greater than KE. So R greater than KE means it is a growing company. For a growing company, the company is able to reinvest the retained earnings at a higher return than KE. Hence, what the company have to do, ideally the company should not pay any dividend, or rather it has to reinvest 100% of the profits. Hence, it should reinvest 100% of profits. So ideal dividend payout ratio is equal to 0%, because everything have to be reinvested. Okay, now the third one, R is less than KE, so it is a declining company. It's a declining company. And what do you have saying? The company is able to reinvest the retained earnings only at a lower return than KE. Hence, should it reinvest anything? No. If you are able to reinvest the amount and you are able to generate a return which is even less than your KE, then why should you reinvest? You pay the entire amount as dividend. Okay, hence ideal dividend payout is equal to 100%. So it is either, in the first case it is indifferent, the second case it is zero dividend payout ratio, or in the third case it is nil. So it is this model is also known as nil or full model. Either you pay zero dividend or you pay 100% dividend. There is nothing in between. Okay, so this is the conclusion with respect to this particular problem. Okay, now let us do some problem. Walter's model. See, the questions from this section will be comparatively easy. It will not be too difficult. Only thing you will have to apply the formula and then find out what is the value of the firm and then see what is the comparison between R and KE. Depending upon that, you have to say whether it is a growing firm or a declining firm or a stable firm and what should be the optimum dividend payout ratio. That's it. That is what maximum you can get from this particular topic. Okay, so let's take the first question. And yeah, XYZ Limited earns rupees 10 per share. The capitalization rate and return on investment are 10% and 12% respectively. Determine the optimum dividend payout ratio and the price of share at that payout ratio. So if you see this, the capitalization rate and return on investment are 10% and 12% respectively. Okay, so capitalization rate is nothing but your cost of equity. Okay, I've told you capitalization rate is the denominator which we follow here. Okay, this is the capitalization factor. KE is the capitalization factor. Okay, so cost of equity is 10%. Then return on reinvestment or return on investment, that is R. R is 12%. So R is greater than KE. So what should be the optimum dividend payout? Optimum dividend payout. How much it will be? 100%. Sorry, it is 0%. Nil. As R is greater than KE, entire profits have to be reinvested because it generates a higher return. Now let us find out what is P. I am doing the calculation here itself. So P0 is equal to D1 plus R by KE E minus D divided by K. So what is D1? D1 is you have to say the dividend payout is nil. So D1 will be 0 plus what is R? R is 12%. KE is 10% into what is E? E is 10. So E is 10. So 10 minus D is 0 divided by 10%. So if you take this, it is 0.12 divided by 0.10 into 10 divided by 0.10. Okay, so that will be 12 divided by 0.10 and that will come to rupees 120. Okay, so 120 is the value per share and the dividend payout ratio. What do you have to do at what will be the dividend payout ratio? The dividend payout ratio should be nil. Now what you can do here is you can prove this ratio by taking different payout ratios. Okay, so let's take it this way. Illustration. dividend payout ratio, let's take 0%, then 25%, then let's say 75%, 100%. So here DPS will be 0%. EPS is 10 in all the cases. 10, 10, 10, 10. DPS, here it is 0, here it is 2.5, here it is 7.5, here it is 10. Okay, so value of the firm P0 is equal to D1 plus R by KE, E minus D divided by KE. So the first one, D1 is 0, R is 0.12 divided by 0.10, E minus D, 10 minus 0 divided by how much? 0.10. We have already computed it to be 120. Next is 2.5 is the dividend, D1. So 2.5 plus 0.12 divided by 0.10, 10 minus 2.5, that is 7.5. So that will give you how much? 7.5 into 0.12 divided by 0.1. Okay, divided by 0.1, that is 9. So this is 2.5 plus 9 divided by 0.10, that is 11.5 divided by 0.1, rupees 115. The next one, it is 7.5. 7.5 is the D1 plus 0.12, 0.10. 10 minus 7.5 will be 2.5 divided by 0.10. That will give you 0.12 into 2.5 divided by 0.1. That is 7.5 plus 3 divided by 0.10. That is 10.5 divided by 0.1. It is 105. Okay, and the last one, that is 10% dividend. It is 10 plus 0.12 divided by 0.10, and 10 minus 10 is 0 divided by 0.1. So that will be rupees 100. So if you see, the value of the company is highest when the dividend payout ratio is 0, that is at 120. So that is what this formula says. If R is greater than KE, the optimum dividend payout ratio will be 0, or value of your firm will be maximum when D is equal to 0. Okay, so that is this particular problem. Now let's move to the next problem. Okay, so let's take this problem here. Okay, now following are the figures collected from the annual report of XYZ Limited. Net profit is 30 lakhs. Outstanding 12% preference shares is 100 lakhs. So this is a new item, 12% preference shares. Number of equity shares is 3 lakhs. Return on investment, that is R. R is 20% and KE is 16%. So R is greater than KE. Okay, so optimum dividend payout ratio is nil or 0. That is the conclusion. Okay, now let's see how it compute the approximate dividend payout ratio so as to keep the share price at rupees 42 by using Walter's model. So you need a share price which is equal to 42. If the share price is to be 42, then what is the what should be the dividend payout ratio? That is what you have to compute here. Okay, so let me do the calculation. So first, what is the net profit here? Net profit is 30 lakhs. but this is the profit before preference share dividend. Now that preference share dividend have to be reduced, so less preference dividend. Preference dividend is how much? 12%. So 100 lakhs into 12% is 12 lakhs. So earnings for equity shareholders, earnings to equity shareholders, it is 18 lakhs. And what is EPS? EPS is 18 lakhs divided by, what is the number of shares? Number of shares is 3 lakhs. So that is rupees 6 per share. Okay, that is EPS. Now you have to find out dividend payout ratio. For that you need to get what is the DPS. Compute DPS. And what is the requirement? P0 have to be 42. So as per Walter's formula, P0 is equal to D1 plus R by KE, E minus D or D1 divided by KE. So that is 42 is equal to D1 we don't know, and R is 0.12. Is it 0.12? No, I think it is 2. So it is 0.2. Divided by 0.16 into E is, we have computed to be 6. 6 minus D divided by 0.16. So to if you simplify this, okay, 42 into 0.16 is equal to D1 plus, what is 0.2 divided by 0.16? It is 1.25 into 6 minus D. Okay, and this will be, what is 42 into 0.16? 6.72 is equal to D1 plus 1.25 into 6 is 7.5 minus 1.25 D1, which means that is 6.72 is equal to, okay, D1 minus 1.25 D1, 7.5 minus 0.25 D1, or D1 is equal to, okay, 7.5 minus 6.72 divided by 0.25. 7.5 minus 6.72, that is 0.78 divided by 0.25, that is 3.12 per share. So what is EPS? E is 6 and D is 3.12. So what is dividend payout ratio in this case? Dividend payout ratio is 3.12 on 6 into 100, and that will be 3.12 on 6, that is 52%. That is the dividend payout ratio. So I hope this is clear. Okay, but this is not the optimum dividend payout ratio, because optimum payout ratio will be 0 because R is greater than KE, so dividend have to be nil. So what you can do as a homework, you can find out what is the value at when dividend payout is 0, and you can also substantiate that when dividend payout ratio is 0, the company or the firm will have a value which is more than 42. Right now, when you follow a dividend payout ratio of 52, the value of the firm is only 42 rupees. Now when dividend payout ratio is 0, the value of the firm have to be higher than 42. Okay, so that's all about this problem. Now I think we have one more problem, so let's take that problem. Again, it is a problem which we have taken from the study material. So the following information pertains to Mrs. XY Limited. Net profit is given to be 5 lakh. Dividend payout ratio is given to be 60%. Number of shares outstanding 1 lakh. Equity capitalization rate, that is R. Sorry, this is KE. KE is 12%, and return on investment, that is R, is 15%. So you have to find out what is the market value per share as per Walters model, and optimum dividend payout ratio according to Walters model, and the market value of the firm at that payout ratio. Okay, so let's do that. Oh, sorry. Okay, so first we have to find out what is the present market value. So present market value P0 is equal to what is D1 plus R by KE, E minus D divided by KE. Okay, number of shares is also given, so you can find out E earnings is equal to 5 lakh divided by 1 lakh, that will give you rupees 5 per share, and dividend payout ratio is 60% of rupees 5, so that is rupees 3. Okay, so this will be 3 plus 0.15 divided by 0.12, that is 5 minus 3 divided by 0.12, and if you sort it out, 5 minus 3 is 2, so 0.15 into 2, that is 0.3, divided by 0.12, that is 2.5, so 3 plus 2.5 divided by 0.12, that is 5.5 divided by 0.12, that is equal to rupees 45.83. This is the value. Now, what is the optimum dividend payout ratio? The optimum dividend payout ratio will be optimum dividend payout ratio is equal to nil. Why? Because as R is greater than K. Okay, so entire amount have to be reinvested. That is the conclusion. So if dividend payout ratio is nil, what will be the value of the firm? Value of the firm P0 is equal to D0 will be 0 plus 0.15 divided by 0.12, E minus D will be 5 minus 0 divided by 0.12, and that is equal to 0.15 into 5 divided by 0.12, 6.25 divided by 0.12, it will come to rupees 52.08 per share. See, the value is increasing when you are going with the optimum dividend payout ratio. Okay, so the value of the firm will be maximum when the optimum dividend payout ratio is applied. Okay, so that's all about Walters model, and now we have to move to the next model, that is Gordon's model for determining the value of the firm. Okay.